Do you know what dividends are and why some companies pay them? Did you know that you can profit when the stock market is crashing? In this video, you are going to learn 3 different ways to profit in the stock market. What's going on, guys? Welcome to the episode 2 of Investing in the Stock Market for Beginners series. In the screen you can see the dates and the subjects of the upcoming episodes. Click the subscribe button so you don't miss anything. This episode is divided into 5 sections, which are price of the shares, dividends, bears and bulls, compounding, summary. Let's get started with the first way to profit in the stock market, price of the shares. One way to profit in the stock market is to sell higher than what you bought the share for. Let's say you bought a share for $10 and now the price is $20. If you sell now, you make a profit of $10. So making money in the stock market is easy. Buy low and sell high. Well, in fact, it's not so easy to know when to buy and when to sell. I mentioned in the episode 1 how the price of the share is determined, but I'll quickly mention it again. Stock market is like a normal market, a place where buyers and sellers negotiate the price. To buy a stock, someone has to sell you the stock. So the stock market is driven by supply and demand. The more demand there is, the higher the price of the stock will rise. And the more supply there is, the lower the price will drop. The price movement indicates what people expect about the company. If people see potential in the company, demand rises and so does the share price. If people don't see potential, the share price falls. There are also different ways and formulas to define the price of a share. The most important financial ratios will be shown in the episode 4 of the series. So to simply put it, buy a share that you think has a lot of potential in the future, and buy it before everyone else is buying it, thus making the price rise. Let's now move on to dividends. A dividend is the portion of the reward you get when you are a shareholder. Dividends are decided by the company's board of directors, but shareholders use their voting rights to approve dividends. Usually dividends are paid in cash, but they could be issued as shares of stock or other property. When companies make profit, they keep some of it for future business activities. The profit that the company doesn't keep is given to shareholders as a dividend. Sometimes companies give dividends even when they are not making profit. This is done with taking debt or using profits made in the earlier years. For example, this company's earnings per share last year was only 8 cents, but they paid dividends 22 cents. This can be done if it doesn't risk the company's operation. Companies can also pay special dividends, which are usually larger than the normal dividends. These are usually paid when company makes more profits than they expected and want to give them directly to the shareholders. Different companies pay dividends at different times. Some companies only pay once a year, some companies pay 2 times a year, some companies pay every quarter, and some pay even monthly. And some companies don't pay dividends at all because they want to keep all the profit they get for future business activities to make the company grow. These companies are usually startups and many technology companies. Usually the best dividend payers are large companies in sectors like financial, healthcare or real estate investments. I have seen many people wonder why the price of a share drops after dividends are paid. As you can see in this graph, when the company issued the dividend, the price of the share dropped. This is because when companies pay the dividend, the amount of money paid is going out of the company's accounts forever, which of course lowers company's equity. The price drop is usually about the same as the amount of dividend. Let's say that the price of a share is $10. If a company pays $2 dividends, the price will drop to around $8. Dividend yield shows how many percentage of dividend-only return you get on your investment. For example, if a company pays $2 dividends annually and the price of the share is $100, the dividend yield is 2%. This comes from dividend divided by the share price, in this case 2 divided by 100. So if you invest $1,000 to a company with a 10% dividend yield, you expect to get $100 in dividends. Reinvesting your dividends has a compounding effect that will be shown later in this video. Let's now move on to bull and bear markets. Bull and bear markets are for more advanced investors, so I'll just briefly tell about them. Bull market means that the price of the stocks are rising, and bear market means that the price of the stocks are falling. The market names are believed to come from the fact that bulls attack by lifting their horns upward and bears attack with their claws in a downward motion. So to profit with bull markets, you have to buy before you think the price is rising and then hold the stock. You can also buy more stocks when the prices are rising if you think the prices will continue to rise. When the prices have risen, you sell them and make profit. the bear market gets a little more complicated. You can make profit when the prices of the shares are falling. The profits are done by short selling, which means that you are selling borrowed shares and buying them back at a lower price. For example, let's say you short 100 shares of a stock at $10 each. You sold 100 shares that you didn't own, you were just borrowing them. Now the price falls to $5 each, so you buy 100 shares back with $500 to replace those shares that you have borrowed and sold earlier. You make a profit of $1,000 minus $500 equals $500. If the prices of the stock rises, you will lose money. There are also other risks involved, like the fact that you are using borrowed money since you are selling borrowed stocks. But that's all I'll mention about bull and bear markets in this episode, since it's more advanced investing. Just to point out that you can also profit when the stock market is crashing. Let's now move on to the last thing, compounding. Welcome to the eighth wonder of the world. As Albert Einstein said, compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. Compound interest is basically interest on interest. You reinvest the profits you get from investing, like dividends for example. Let's say you invest $10,000 with annual interest of 10%. In the first year you will make $1,000 profits, so now you have $11,000. In the third year you will make $1,100 profits, so now you have $12,100. With simple interest you don't reinvest your profit, so you only make $1,000 every year. In the long run this makes a huge difference in your profits. For example, in 50 years with this $10,000 investment and 10% annual interest, your simple interest profits would be 50 times $1,000 equals $50,000. But with compounding interest, your profit would be almost $1.2 million. I'll put a link to a compound interest calculator in the description so you can test yourself how huge the profits can be with compounding in the long run. The formula for compound interest is shown on the screen. In the formula, C means compound interest, P is principal, R is the interest rate, and N is the number of periods. So in our example, P is $10,000, R is 0.1 and N is 50. If you put this to a calculator, you can see it adds up to almost 1.2 million. So time is a huge factor in your profits. You should start investing as soon as possible. It is a huge difference if you start at the age of 20 compared to starting at the age of 30. Let's now summarize the video. One way to profit in the stock market is to sell the stock at a higher price than what you bought it for. The price of the stock is determined by supply and demand. The more demand there is, the higher the price will be, and vice versa. A dividend is the portion of the reward you get for being a shareholder. They are usually paid in cash. Companies can also pay special dividends. This is usually done when companies make more money than expected. Dividend yield shows how many percentage of dividend-only return you get on your investment. It comes from dividend divided by the share price. Bull market means that the prices of the stocks are rising. You can profit by buying low and selling high. Bear market means that the prices of the stocks are falling. You can make profit with short selling. You sell stocks that you have borrowed and later buy them back for a lower price. Compounding interest means that you reinvest the profits you make from your investments. This makes a huge difference compared to simple interest in the long run. Thank you for watching episode 2 of Investing in the Stock Market for Beginners series. Please comment down below what's your favorite way to make money in the stock market. Do you look for dividend companies or try to trade for better prices? Next week's episode will be about risks and diversification. So click the subscribe button and the notification bell so you don't miss out. On Sunday I'll make a book summary about Bitcoin. Feel free to check that out too. Have a nice day and I'll see you later.